cash. Folks, we have a lot of news about the fourth stimulus check, Social Security benefits, SSI, and SDI. Continue watching this video because you don't want to miss out on this. For the vast majority of Social Security beneficiaries, their monthly check is vital to their financial well-being. After 20 years of annual polling, it is found that no less than 80% of retirees rely on their Social Security benefit in some capacity to meet their monthly expenses. But with the U.S. debt limit and ceiling deadline looming, more than 66 million beneficiaries are wondering whether the Social Security checks will be on the chopping block. The debt ceiling represents the authorized borrowing limit for the federal government. It's important to keep in mind that it doesn't include borrowing for new spending or projects. Rather, it's to cover the federal debt limit and existing financial obligations. At no point in America's history has the federal government defaulted on its legal financial obligations, which is why the current debt limit impasse between Democrats and Republicans on Capitol Hill was turning heads. The expectation prior to this week is that Treasury lawmakers had perhaps 2 or 3 months to agree on a bill that would raise, because the payments are just based on a number of things. People in different households, like your income payments, favorite families, and if you're having a dependent, you'll get more money. Under the American Rescue Plan from Joe Biden, he signed into law. It did send out $1,400 per person, but this means that larger families are likely to get some bigger checks with people compared to the people who have no money at all. In Idaho, where IRS data showed that households enjoyed the second biggest average payout, at $2,300 a month for people with around 2.5 dependents. States with the smallest average per household payments are people in the Northeast, rounding at the bottom. That's around $2,000 a month of stimulus cash, everybody. And Massachusetts had also the biggest and second smallest payment at an average of $2,200 a month. Families in the Northeast tend to be smaller compared to those in many western mid-states, because those people have higher incomes and likely limited number of people eligible that are in for more stimulus cash. For instance, the last round of checks provided $1,400 to each single taxpayer, and now it's $2,800 if you're filing and making less than $150,000. Above those dollar thresholds, the payments taper off. The IRS announced that more than half of the payments have been sent to households making less than $50,000 a year. Households earning less than $10,000 received the greatest number of payments, with the tax agency sending more than 22 million checks to the income group. That's far more than expected. Back in September, though, the IRS announced it was attempting to contact the nearly 9 million low-income people, an important part of our fabric of our state, and help us continue functioning during this time. The Minnesota Department of Labor and Industry announced that applicants who chose direct deposit will see their checks within 10 days. However, you could see your payment within 3 to 4 weeks if you chose to receive the compensation via debit card. Applicants who applied should have received an email informing them if they were approved or denied for the one-time payment. And the temporary commissioner of the state's labor department said that the industry and the money is subject to federal income tax, but not the state income tax. And lower gas prices in Minnesota, along with cheaper used cars, slowed inflation for a second straight month. But new inflation reports have actually painted a far rosy picture as many other items increased in prices. Consumer prices surged 8.3% last month, down from 8.5% from a year-over-year increase in July. Inflation is still painfully high as food and energy prices remain volatile, but is down from the 4-decade high of congressional Democrats not to raise taxes on those earning less than $400,000. The federal taxes would increase by $17 billion on American taxpayers earning less than $200,000, and those making between $200,000 and $500,000 would see the levy jump by $14 billion. By 2031, when the new energy credits and subsidies are set to provide an even greater benefit to higher income Americans, those earning below $400,000 are projected to pay as much as 2/3 of the additional tax revenue collected that year. But Manchin argued Sunday on CNN that the bill is not putting a burden on any taxpayers whatsoever. He added, "We're doing what we can to make sure we address the problems, and there are solutions to the problems we have." Manchin was a key holdout on the Build Back Better plan for more than a year, causing heavy criticism from his Democratic colleagues and advocates. Now, a bill to repeal legislation that will reduce or eliminate Social Security benefits for retired federal employees and their spouses is coming very close to a House floor vote. The Social Security Fairness Act, introduced by a representative, has more than 200 co-sponsors in Congress. That is more than enough to force a House floor vote. The bipartisan legislation would eliminate two provisions of the 1935 Social Security Act that reduce or eliminate the Social Security benefits of more than 2 million retirees. One is the windfall elimination provision, which reduced the Social Security benefits of local, state, and federal retirees who worked in Social Security covered employment. Lawmakers expect a vote on the legislation that may soon come as September. Co-sponsors of the bill have told reporters that no American should be penalized because of their public service, and they've been waiting decades for a solution to this issue, and now we are close towards fixing this problem. And the National Active and Retired Federal Employees Association has advocated for Congress to eliminate WEP and GPL from the Social Security Act for years. The SSA currently estimates its ability to pay full-out benefits will run out in 2035, at which point it will pay only about 80% of benefits owed to people that are supposed to get it.
Thank you, Mr. President. Later tonight, the Senate will vote on my amendment, number 5185 to the PACT Act. And as my colleague from New York was just saying, it is time that we deal with the issues of toxic exposure.
It's happening. The millions of people may see a drastic increase and decrease in monthly benefit checks. Direct deposit of checks or set to go out to Social Security recipients may be adjusted from the federal government. And there is some shocking news. A new Congressional Budget Office reports projects that an even more dire outlook for Social Security's future than was previously calculated. Without action to fix the situation, huge benefit cuts for recipients will begin in 2033, and preventing those cuts will require massive tax increases for working Americans beginning immediately. In contrast to the Social Security's trustees' own projections, the Congressional Budget Office estimates that Social Security's combined retirement and disability insurance programs will run out of money again just 2 years earlier. And now that tax increases necessary to fund scheduled benefits are higher than the Social Security's trustees projected. The trustees also assumed only 4.5% price inflation in 2022 and 2.3% in 2023, while the CBO report accounted for the recent 8.7% cost of increase. According to economists, Social Security's future is not secure. The program is running out of time and money. Recent increases in government spending and debt have crowded out options for reform, and virtually all Americans stand to lose some policy enactment. The Congressional Budget Office report stated that there are 5 main issues right now with Social Security, and the first is that Social Security has a spending problem. Social Security will only be able to pay out 2% tax, and the program promised to take never more than 6% of a worker's paycheck. Today it takes 12%, and even that falls short of the program's ever-rising cost. The Congressional Budget Office projects that Social Security's costs will increase by 42% of the next 75 years, as its revenues remain stable. Protecting Social Security requires reining in on the excessive cost growth, and actually means benefit cuts of 23%. Current law requires that Social Security benefits come from within the program, so once the fund draw runs dry, Social Security will only be able to pay as much as benefits as it receives in taxes. That will mean a roughly $5,000 cut in annual benefits for a typical retiree, and about $4,000 less for the average disability beneficiary. Congressional Budget Office also stated that as of right now, anyone who is 65 or older will not reach today's Social Security retirement age. That's before the age of money runs out. Also, anyone